Welcome to our CMA Part 1 preparation playlist with Pixel Plus. Hi everyone, and thank you for joining us on this journey to mastering the CMA Part 1 syllabus. Whether you're new to the Certified Management Accountant program or looking to brush up on your skills, you're in the right place. In this series, we'll be breaking down the entire Part 1 syllabus, covering everything from external financial reporting decisions to planning, budgeting, and forecasting. Each lecture is designed to give you a comprehensive understanding of the key concepts and help you tackle the exam with confidence. Before we dive in, make sure to subscribe to our channel and hit the notification bell so you don't miss any of our upcoming lessons. Now, let's get started and take the step towards your CMA certification success. Part of our chapter number 1 of CMA series, the statement of cash flow. The statement of cash flows is an essential financial statement that provides a detailed account of a company's cash inflows and outflows over a specific period. This statement is divided into three main sections: operating activities, investing activities, and financing activities. The statement of cash flows is crucial because it helps stakeholders understand how the company generates and uses its cash, providing insight into its liquidity and financial health. It complements the income statement and balance sheet, offering a comprehensive view of the company's financial performance. A cash flow statement is a financial document that provides a detailed analysis of a company's cash inflows and outflows over a specific period. It is one of the key financial statements used by investors, creditors, and management to assess the financial health and performance of a business. The cash flow statement is divided into three main sections. First is the operating activities. This section records the cash generated or used by a company's core business operations. It includes cash receipts from sales of goods and services, cash payments to suppliers and employees, and other expenses related to day-to-day business activities. This section helps stakeholders understand the company's ability to generate cash from its regular operations. Second is investing activities. This part of the statement details cash flows related to the acquisition and disposal of long-term assets such as property, plant, equipment, and investments. It includes cash payments for capital expenditures, cash received from the sale of assets, and investments in securities. Investing activities provide insight into a company's growth strategy and its long-term financial health. And the third is financing activities. This section highlights cash flows associated with a company's financing structure. It includes cash received from issuing debt or equity, repayments of loans, dividends paid to shareholders, and other transactions involving the company's own financing. This section is crucial for understanding how a company funds its operations and growth through external sources. The cash flow statement complements the balance sheet and the income statement by providing a clear picture of how cash is generated and utilized within a business. It is essential for assessing a company's liquidity, solvency, and overall financial flexibility. By analyzing cash flow statements, stakeholders can make informed decisions about investing in, lending to, or managing the company. Cash flow from operating activities, CFO, is a crucial section of the cash flow statement. It represents the cash generated or used by a company's core business operations during a specific period. Unlike net income, which includes non-cash items like depreciation and amortization, CFO focuses solely on actual cash inflows and outflows, providing a clear picture of a company's operational efficiency and liquidity. Importance of cash flow from operating activities. One indicator of operational health, CFO shows whether a company's core operations are generating sufficient cash to sustain the business. Positive cash flow from operating activities indicates that the company is generating enough cash to maintain and grow its operations without relying on external financing. 2. Liquidity assessment. CFO helps assess a company's liquidity by showing how well it can cover its short-term liabilities and operational costs with the cash generated from its business activities. 3. Investment and financing decisions. A healthy CFO provides a solid foundation for making informed investment and financing decisions. Companies with strong operating cash flow are better positioned to invest in new projects, pay dividends, and meet debt obligations. 4. Comparative analysis. CFO allows investors and analysts to compare the operational efficiency of different companies, even if they operate in the same industry. It also helps in comparing the company's performance over different periods. Components of cash flow from operating activities. Cash flow from operating activities is typically calculated using either the direct method or the indirect method. 1. Direct method. The direct method lists all the major cash receipts and cash payments during the period. This method is more straightforward and provides a detailed breakdown of cash flows. The key components include cash receipts from customers. This includes all cash collected from sales of goods or services. Cash payments to suppliers. This covers cash paid for raw materials, inventory, and other supplies. Cash payments to employees. Wages, salaries, and other employee-related expenses are included here. Cash payments for operating expenses. This includes cash paid for rent, utilities, and other operational costs. Cash payments for interest and taxes. This includes cash outflows for interest payments on debt and tax obligations. 2. Indirect method. The indirect method starts with net income and adjusts for changes in balance sheet accounts to convert accrual-based net income to cash-based CFO. This method is more commonly used and focuses on the differences between net income and net cash provided by operating activities. The key adjustments include net income, the starting point, representing the profit or loss for the period. Depreciation and amortization, non-cash expenses that reduce net income but do not affect cash flow. Changes in working capital, adjustments for changes in current assets and liabilities, such as accounts receivable, inventory, accounts payable, and accrued expenses. Gains and losses on sale of assets, adjustments for non-operating gains or losses that affect net income but not CFO. Deferred taxes and other non-cash items, adjustments for changes in deferred tax liabilities and other non-cash items. Investing activities, a critical section of the cash flow statement, detail the cash transactions related to the purchase and sale of long-term assets and investments. These activities are essential as they show how a company is allocating its resources for future growth and expansion. Typically, investing activities include the acquisition and disposal of physical assets like property, plant, and equipment, as well as investments in securities like stocks and bonds. For example, when a company buys new machinery or invests in another business, these transactions are recorded under investing activities. A positive cash flow from investing activities might indicate that a company is selling off assets, which could be a strategy to raise cash or a sign that it is divesting from non-core operations. Conversely, a negative cash flow from investing activities usually suggests that a company is investing heavily in its growth by purchasing new assets or expanding its operations. While negative cash flow in this section can be a good sign of growth, it's also important to consider how these investments are financed and whether they are likely to generate future returns. Understanding investing activities is crucial for stakeholders to assess a company's growth strategy and capital expenditure. For instance, continuous investment in new technology or facilities may position a company well for future competitiveness and market expansion. However, excessive or poorly planned investments might strain the company's financial resources. Therefore, analyzing the trends in investing activities alongside other financial metrics provides a more comprehensive view of a company's overall financial health and strategic direction. Financing activities, another essential section of the cash flow statement, illustrate how a company raises capital and returns funds to its investors. These activities include transactions related to issuing and repaying debt, issuing and buying back shares, and paying dividends. For example, when a company takes out a loan or issues new shares, it is generating cash inflows that are recorded under financing activities. Conversely, repaying loans, buying back shares, and paying dividends to shareholders result in cash outflows. Understanding financing activities is vital as it provides insight into a company's financial structure and strategy. Positive cash flow in this section might indicate that a company is raising funds to support growth or improve liquidity. However, it could also suggest increasing debt levels, which may raise concerns about financial stability. Negative cash flow from financing activities often means that a company is paying down debt, buying back shares to increase shareholder value, or distributing profits through dividends. Analyzing these activities helps stakeholders assess how the company manages its capital structure and funding needs, as well as its commitment to returning value to shareholders. The statement of cash flows includes important notes and disclosures to provide a clearer understanding of a company's cash transactions and financial position. One key disclosure is for non-cash investing and financing activities, which include significant transactions that do not directly involve cash, such as converting debt to equity or acquiring assets by assuming related liabilities. These are disclosed separately to highlight their impact on the company's financial situation. Another crucial disclosure involves the reconciliation of net income to cash flow from operating activities, especially when the indirect method is used. This reconciliation adjusts net income for changes in working capital components, like accounts receivable and inventory, as well as non-cash items such as depreciation and amortization. This helps stakeholders see the connection between the company's reported earnings and the actual cash generated from its operations, providing a more comprehensive view of its liquidity and financial health. In conclusion, the statement of cash flows is an essential financial document that provides a comprehensive analysis of a company's cash inflows and outflows over a specific period. This statement is divided into three main sections: operating activities, investing activities, and financing activities, each of which offers unique insights into different aspects of the company's financial health and performance. Cash flow from operating activities. Cash flow from operating activities, CFO, focuses on the cash generated or used by a company's core business operations. This section excludes non-cash items such as depreciation and amortization, providing a clear picture of a company's operational efficiency and liquidity. CFO is a crucial indicator of a company's ability to generate sufficient cash to sustain and grow its operations without relying on external financing. It helps in assessing the company's liquidity, making informed investment and financing decisions, and comparing operational performance across different companies and periods. The direct method of calculating CFO lists all major cash receipts and payments during the period, offering a detailed breakdown of cash flows from customers, suppliers, employees, operating expenses, interest, and taxes. The indirect method, more commonly used, starts with net income and adjusts for changes in balance sheet accounts to convert accrual-based net income to cash-based CFO. This involves adding back non-cash expenses like depreciation and adjusting for changes in working capital components such as accounts receivable, inventory, accounts payable, and accrued expenses. Cash flow from investing activities. Investing activities detail the cash transactions related to the purchase and sale of long-term assets and investments. This section includes the acquisition and disposal of physical assets like property, plant, and equipment, as well as investments in securities. A positive cash flow from investing activities may indicate that a company is selling off assets, possibly to raise cash or divest from non-core operations. Conversely, a negative cash flow suggests heavy investment in growth through asset purchases or expansion efforts. Understanding investing activities is vital for stakeholders to assess a company's growth strategy and capital expenditure. Continuous investment in new technology or facilities can enhance a company's competitive edge and market expansion potential. However, excessive or poorly planned investments might strain the company's financial resources, making it crucial to analyze these trends alongside other financial metrics for a holistic view of the company's financial health and strategic direction. Cash flow from financing activities. Financing activities illustrate how a company raises capital and returns funds to its investors. This section includes transactions related to issuing and repaying debt, issuing and buying back shares, and paying dividends. Cash inflows in this section might come from taking out loans or issuing new shares, while cash outflows can result from repaying loans, buying back shares, or paying dividends to shareholders. Understanding financing activities provides insight into a company's financial structure and strategy. Positive cash flow in this section might indicate efforts to raise funds for growth or improve liquidity, but it could also signal increasing debt levels, raising concerns about financial stability. Negative cash flow often means the company is paying down debt, buying back shares to boost shareholder value, or distributing profits through dividends. Analyzing these activities helps stakeholders understand how the company manages its capital structure and funding needs, as well as its commitment to returning value to shareholders. Importance of notes and disclosures. The statement of cash flows includes essential notes and disclosures to provide a clearer understanding of a company's cash transactions and financial position. Non-cash investing and financing activities, such as converting debt to equity or acquiring assets by assuming related liabilities, are disclosed separately to highlight their impact on the company's financial situation. Reconciliation of net income to cash flow from operating activities, especially when using the indirect method, is another crucial disclosure. This reconciliation adjusts net income for changes in working capital components and non-cash items, helping stakeholders connect the company's reported earnings with the actual cash generated from its operations. Summary. The statement of cash flows is a pivotal financial document that complements the balance sheet and the income statement by providing a clear picture of how cash is generated and utilized within a business. It is essential for assessing a company's liquidity, solvency, and overall financial flexibility. By analyzing the cash flows from operating, investing, and financing activities, stakeholders can gain comprehensive insights into the company's financial health, operational efficiency, growth strategy, and capital management. This information is critical for making informed decisions about investing in, lending to, or managing the company. Understanding and effectively utilizing the statement of cash flows is fundamental to evaluating the financial stability and efficiency of a business.
So that's it for our today's class. Thank you for watching, and if you found this video helpful, don't forget to give it a thumbs up and share it with your friends. For more in-depth CMA course content and updates, make sure to hit the subscribe button and click the bell icon so you can never miss an upload. Do you have any questions or topics that you would like to cover? Leave a comment below. and I will be sure get back to you. Follow us on our social media channels for additional tips, resources, and community support. Thank you again for your support. Keep learning and see you in the next video. Thanks for the watching.